Kia ora and welcome to Shared Lunch, brought to you by Sharesies with BusinessDesk. This week, we're joined by Mark Heine, who is the CEO of road charging and transport fleet technology business EROAD. Mark speaks with BusinessDesk editor Patrick Smelly. EROAD has announced that it is seeking to raise $50 million of new capital via an institutional and retail offer, including the issuing of new shares in EROAD. Sharesies will be distributing the retail offer to Sharesies investors, for which Sharesies will receive a fee. This conversation with Mark Heine doesn't talk about the offer as such, but about EROAD more generally, including its plans for the future. Before we get started, here's some important information.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Well, morning, Mark. Thanks very much for joining us.
Hi, Patrick. Good to see you again.
Good to see you. I thought perhaps it would be useful for this audience if you could just start us off with a general overview. What does EROAD actually do?
Sure, thanks, Patrick. So EROAD, we're what's called as a telematics company. So what we do is we monitor vehicles on the road, and our footprint extends from New Zealand, Australia, and also into the US. And what we do is we gather a huge amount of data, so each year over 30 billion data points from vehicles, and we use that data to provide a range of applications and products to our customers. That may be around road user charging. We can automate that for our New Zealand customers. We can help manage compliance opportunities in Australia. We help encourage productivity and safety for our customers as well across the US, New Zealand and Australia as well. So we help our fleet operators and our drivers be safe on the road. There's also an element around sustainability too. We know that transportation is a major source of emissions in all the countries we operate in. So we have some great tools to help our customers manage their sustainability as well.
So is this a business that exists thanks to the advent of the Internet of Things in a sense?
Indeed, exactly right. So we are classified as an IoT device. We connect into the mobile networks and then ultimately into the cloud. So every vehicle, and there's about 227,000 vehicles across the three countries we operate in who use EROAD. So we have a hardware in the vehicle and we use that to provide data solutions for our customers.
So that helps with, as you say, monitoring drivers, safety, kilometres covered. I mean, do you effectively in New Zealand assist with calculating road user charges and that sort of thing as well?
That was our genesis. So our founder, Stephen Newman, back many years ago, looked at a very paper-based road user charges system that we had in New Zealand. So every heavy vehicle had to carry a license on the windscreen that made it very administratively burdensome and also tied up a lot of working capital on the windscreen. So what we did is we created it's the world's first electronic mobile road user charges payment system. And what that meant is we put our devices in every vehicle who was keen to use us, and we had very significant uptake. Around 50% of all heavy vehicles on a voluntary basis now use EROAD to manage their road user charges obligations. And what that means is they can really easily understand how much they're going to pay for use of the roads. They can do it automatically. It also then means that by collecting that data, we can have other applications as well around health and safety. So we know how the driver's going. Are they speeding? Are they fatigued? Have they driven too long? And then we can also understand more areas around, how we can drive better productivity in the fleets, how we can understand the sustainability impact of using internal combustion vehicles and whether we can transfer them into electric vehicles. We've got a range of applications we can provide to our customers off the back of it.
Yeah, when we spoke a couple of months ago, one of the things that intrigued me was the extent to which your package might allow, for example, a trucking fleet to understand who's driving well and who's badly, and what that might have. You get a sort of a double effect out of maybe better fuel efficiency, but also lower carbon footprint. How does that all work, and where, what does the future hold in terms of the kinds of things you could add on?
Sure. So we've got about 250,000 drivers who use EROAD. That gives us a massive pool of different drivers and their behaviours for us to see who's a good driver and who's a poor driver. And one of our key products we have is what's called the driver Leaderboard. And that compares fleets to show which fleets are more superior than others on an anonymised basis. You can kind of see how you're based versus other fleets in your industry. Then on a one-by-one level, you can look at your drivers within your fleet, see what we call a 5-star driver. So they're the ones who are safe, they consume less fuel, and they show that they have a really good road proficiency, all the way down to those drivers who are poor. And what that does is it gives a fleet operator a chance to help train their drivers up, because what happens is it's real money out the door if they drive poorly. It also means it can be a detraction on the company as well, given that every vehicle for our fleets are typically a moving billboard for them. So it gives them a chance to help train their drivers up and improve them. Over time, using that data, it does also provide us with ability around AI and machine learning. So for an example, knowing what the drivers are doing and where the routes are, you can then provide some really good smarts to say to them, hey, given the weather or given the load you're carrying today, maybe you shouldn't take that route, you should take a different route. You've put in their place also transportation congestion and the like. Also means you can provide better smarts as well to help bespoke that experience for our fleets and also for the drivers. So there's a great future around how we can improve productivity and safety for our customers off the back of that.
And how do you monetize that? Do you charge something for each sort of module of that suite of possibilities, or how does it work?
So there's a couple of ways we go about it. So typically most customers, when they come to EROAD, they take both a hardware device and also they pay a SaaS fee, so it's software as a service fee to us. So we typically do it on a leasing basis for between 36 months and 50 months. So if you're a transportation operator, you come along, you'll put the hardware in the vehicle, we'll help you install it. That then connects to the cloud, and you pay then for the applications you use in the cloud of the base of that SaaS services. We also have additional add-ons as well. So we do have mobile applications. That includes one for work time. A lot of our drivers need to be able to manage their work time rules around making sure they don't drive too much in a day, so we can charge for the use of a mobile app there. We have pre-vehicle driver inspection app as well. As we sort of grow, we also look at a professional services element too. So a good example of that is for our larger enterprise fleets, not only are we collecting a whole bunch of data for them, we also need to integrate it into their back end. And that gives a whole new additional way of earning revenue too. So off the back of the Cisco deal, which is a very large operator in the US, which we won back in November last year, of over 9,000 vehicles, they're the world's largest food services company. Not only are we providing the hardware and the mobile applications and the SaaS applications, we also charge a professional services fee to integrate that into the back end too. So it's another means that we can get revenue for our business as well. Over time, as part of our strategy, we know we're actually really successful with enterprise fleets. We've got a really great number of enterprise fleets in New Zealand, like to Downer, Fulton Hogan, and the like. In the US, we've got Cisco and ODFL. As we advance on those enterprise fleets, there are more additional services we can sell and earn additional revenue off the back of it too. So it's a point where we're focusing on going forward as well, Patrick.
So take me through the growth story, because as I understand EROAD's strategy, great to make inroads into the New Zealand market, but if you're going to be a highly successful SaaS firm, you have to have you want to try for global reach. If anything, it's not that you've bypassed Australia. Australia is a significant market for EROAD, but as I understand it, North America is where you're focused. Just wondered if you could walk us through how you got in there, maybe talk to us a bit about the Cortex purchase a couple of years back and how that folds into your global, or at least at this stage anyway, North American growth strategy.
Absolutely. So it goes back to the road user charger story I talked about earlier, being an innovator in that space, and New Zealand being the first country in the world where we introduced it. In the US, some states as well have a similar system called Weight Mile Tax. So we began in Oregon in 2014. We launched that product into that state. Off the back of that, as we do with our other services, we then saw we could sell some further added value services to our customers. So from being a weight mile tax provider, we then went into health and safety, and we grew off the back of that. Over time, we then merged with Cortex. We did that merger back in 2021. And the reason for that is, Cortex was another really strong Kiwi innovator, but they had been more successful in the US. They'd gone into the market and focused on enterprise customers a bit earlier than what we had, and so we're a bit more successful at the back of that. So we saw a really good complementary nature and sort of joining forces. And that meant that EROAD, who are really good at the regulatory side in terms of managing responsibilities around health and safety and paying taxes to the government, we combined that with Cortex's applications, which they were really sophisticated applications around managing cold chain as well as construction and waste and recycling. So
Cool chain, you mean for refrigerated trucking?
it's a cool chain for refrigeration trucks. So there's a number of refrigeration trucks in the US that need monitoring, and that's principally around making sure that it's keeping the goods cool and the ongoing assurance around that end. And it's actually a really innovative product that Cortex developed. So we saw some really good synergies there. In addition, they had a new generation hardware device, which meant we could better target our enterprise customers as well. So that merger, which sort of finalised back in around December of 2021, allowed us to sort of turbocharge our growth into North America. We could kind of leap forward about 2 years worth in terms of technological innovation as well as sort of customer base as well. Over the course of the last sort of 18 months, we've been sort of consummating that merger, and we've been sort of developing and launching new products into the US off the back of it. And part of that is sort of integrating our camera solution, which EROAD had launched into the markets, alongside some of the other products that Cortex had. Off the back of that, we've won, obviously, the Cisco opportunity in the US, which is another 9,000 connections. And it's meant that we've really learned that we can focus on that high value end of the market, those large customers that need more than just sort of a dot and a map, which is some of what the basic telematic companies do. We said they need better integration, more visibility, high uptime and accuracy is really important as well. Those are things that EROAD and Cortex are really good at doing. So it's enabled us to sort of really grow in North America. Off the back of that, we've just passed 100,000 connections in North America, which is a massive milestone, particularly for an ANZ company to achieve in what is quite a competitive market around telematics in North America. So we're really proud of our journey, and we know there's a lot of room we can do to grow off the back of it as well.
So if you were to break it down, what is the current market share of each of your three main markets, New Zealand, Australia, US, look like? And maybe could you give us a sense of where you would hope to be in, say, 5 years' time?
Sure. So if we look at our breakdown, we've got about 230,000 connected units globally. Of that, about 115,000 are based in New Zealand, 100,000 in the US, and about 15,000 connections in Australia. With Australia, we do see some good growth that we can get into that market, and then what we're focusing on then is those sort of top-end enterprise customers as well. So Ventia was a really great win that we had about a year or so ago, and that's a trans-Tasman fleet, and looking after the sort of civil construction side of that. We're targeting other customers in that space as well, and we've just recently secured another win, and as part of the announcement we made today, there's about a 3,000 unit connection deal we won in Australia off the back of that Ventia deal. We also are focusing on cool chain. It's a very hot continent, Australia, so there's lots of refrigerated vehicles there, and we're looking at how we can sort of build up our base there, as well as around the construction side in Australia too. We've got some good customers in construction. So we sort of see that having some pretty moderate to good growth over the course of the next few years. Our real focus, though, is actually building out more into the US. So we've surpassed that 100,000 threshold. This year, we've indicated to the market that we're going to grow our revenue globally by around 6 to 9%. We're targeting by FY26 growth on an annualised basis of around 11 to 13%. So it gives us sort of a good visibility around how we think we're going to grow in the US market. And that's off the back of some of those really strong fleets we have obtained already, and the ones that we're targeting in addition to those as well.
Look, you've mentioned a number of firms which I think New Zealand and perhaps Australian investors would be well aware of in these markets, Fulton Hogan, Ventia, Downers and others. What's the significance of some of the wins that you've had in the US? Because one or two of them are probably larger players than people are aware of. Not all of the names that are in your presentations are familiar to me, but I know that some of them have scale. And I presume that winning at scale is what invites others of scale to consider the product.
Exactly right. So take a couple of examples. So Cisco, the one that we won, is a $67 billion turnover company of over 650,000 customers. They're very large in scale, over 9,000 vehicles. We won their in-cab business. They've also got refrigerated trucks as well, which we're looking to target going forward as well. So they're a massive marquee brand. They're a bit like the Bidfood of New Zealand. So for those in New Zealand who know Bidfood, who deliver food to restaurants, cafes, dairies and the like, they're like them but larger. Bidfood is another one of our accounts that we have in New Zealand. There's another company called Old Dominion Freight Lines, ODFL. They're, again, a very large transportation operator, and and they've been incredibly successful in helping deliver goods for their customers across the whole continent of the USA. Again, they're a very prominent brand and seen as one of the best adopters of technology in transportation fleets in the US. So the fact that we have them as a customer is a really good proof point to show that the strength of our technology is up there with the best. Another company is called American Building Company, or ABC Supply. So they're a very large operator there, which we have 6,000 connections with, and they deliver roofing supply and other building materials to customers all across the continent of the US as well. So they're just some examples of some really top quality customers that we have in the US. And what it does is it provides a really good proof point around who we can actually achieve and the confidence we can obtain with them, and that then creates opportunities to sell into other fleets who are complementary to them or even their competitors as well.
And do you focus on any particular states? I mean, how do you deal with the fact that presumably every time a truck crosses a state line, there's some slight difference in the regulatory environment, which presumably your products have to be able to pick up and deal with?
Exactly right. It's a great question. So first, we do target all of the US in terms of our sales team. So we're in the process right now in terms of focusing on a North American growth to build up a stronger enterprise team. It's a bit of a strategic pivot for us. Traditionally, EROAD focused on the small to medium businesses in North America. Off the back of the Cortex merger and the strategic review that we announced to our shareholders back in March, we said we wanted to concentrate more so on enterprise customers, and that's meant that we're building up a really strong team across all of the US to enable that. In terms of technology and managing the idiosyncrasies of the different states, you're right. No, the rule engines that we have to be able to manage the drivers' work times, the tax obligations around paying for the use of the road and the like across various different states. And our product does that. Now, there's a lot of smarts that goes into understanding that, and it goes back to our DNA of being really good at solving complex regulatory issues in transportation and being able to build out strong solutions off the back of that to help our customers manage those different state requirements across where they drive.
To fast forward through a period post-COVID, the share price went for a hell of a skate. By the time that Constellation Software, Valaris, were making a bid for the company in June, the total enterprise value of that bid was $149 million. So take us through what's been happening, why that all happened, and how the future pans out.
So around about January and February of that year in 2022, when it came to technology stocks, there was a bit of a market correction. So for those technology stocks who were either in a cash burn mode or were carrying debt, they were seen less favourably to the market than those who were sort of being free cash flow positive. EROAD, alongside a number of other stocks, got impacted by that, and we saw a downturn in our share price. Off the back of that, we also had some change in management structure as well. I came into the role as CEO. So there's a bit of a question around some uncertainty at the time around EROAD. Now, we've gotten past that. We've built out a really strong management team. We've also shown that we can actually deliver off the back of the merger too, and that's seen by some customers that we've been renewing and bringing online too. But it's really down to EROAD to prove that to our shareholders, and we know we've got to continue to do so. So we did announce back in March of this year a revised strategy for EROAD, and that was launched by myself and our CFO, who we brought on, Margaret Warrington, who joined us in that permanent role in December last year. And it focused on two limbs, which is really important for our shareholders to understand. First was around turning around the core, and the reason for that was, given the need to bring back the cash burn, it's really important that we focus on how do we reduce costs. So we looked into the business holistically and realised that we can remove some of the costs that we were seeing in the business. And we have targeted and removed $10 million on an annualised basis last financial year. And we've targeted another $10 million to remove this financial year. And we're confident we're going to remove all of that. We're about $17.5 million of our way there. So there's another $2.5 million we need to identify. But bringing that cost base down and moving us towards a free cash flow positive is really important. And we've given guidance to the market that we're going to be in a free cash flow neutral stage during FY25, so towards the back end of next year, and then being free cash flow positive in FY26. And that's really important to give confidence to our shareholders that we can actually get ourselves back on track. As an example, when I came as CEO back in the beginning of last year, our cash burn was around $4.2 million a month each month. We brought that down to being $1.5 million a month in this quarter, in Q1, of this financial year, and we're going to see continued improvements in the course of financial year going forward. The other key area we need to give confidence on to our shareholders was that growth in North America. And that's around having the right product in the market, winning the right customers and building up the right sales team. And again, it's about delivering on that and giving the confidence to our shareholders. In that end, we have already seen some good fruits of that in terms of some of the accounts we won, I talked about earlier. We're building up a really strong enterprise sales team in the market as well. And we do have confidence that over time we're going to achieve those numbers of growth of between 11 and 13%. So I do acknowledge it has been a rocky time for our shareholders and the share price has been impacted off the back of it. But we have a really good plan to take us forward and we're starting to see the fruits of that coming in already. And we're confident we'll be able to deliver on that.
So I think it would be good to put a little bit of context around that. $20 million lower total expense base on an expense base of what? I mean, what's that as proportion? How do we know that you're not just burning the floorboards to make it look good?
No, we're absolutely not. So when we did the review, we looked at those parts of business which may have grown too fast. So in certain areas, perhaps off the back of COVID and the need to many people were trying to hire talent as much as possible, we perhaps overhired in certain spaces around the corporate function, around our engineering function and like. So we looked at our headcount and we reduced it down from around 600 odd to around today 475 permanent and a few contractors on top of that too. And it's not the burning the floorboards approach. What we were looking at though is actually going, what is the right size of the headcount for an organisation such as EROAD? And we believe that is the right sort of size. We looked at certain other areas too. We repatriated some of the functions from the US into New Zealand, which is a lower cost base, and we saw that's important. And also, off the back of COVID, people do engage in more flexible work, so we have actually brought down our property footprint as well. So we closed an office in Portland, and rather we have 2 offices in the US now, one in San Diego and one in New Jersey, so we didn't need the third in Portland. EROAD in Auckland had about 4 office locations. We've now brought them down to 2 as well, and that's had quite a significant savings. In addition to that, we've also looked at, as a merged company, we can actually use our increased scale to actually have better terms with our suppliers. So we've been focusing on renegotiating some of our contracts with our suppliers and have brought down the cost of those doing so too. So by doing so, our cost out program has actually been enabling us. And what we've guided the market to do is we're not going to be increasing operating costs outside of growing our revenue. So our revenue will continue to increase, but our core operating costs we're looking to keep flat during the course of the next couple of years. As part of that, we've had to reallocate some of the spend into the US and then trim it in other parts of operations as well.
So I think I'm right in saying that on an NPAT basis, the business lost about 7.2 million in the year to March 31st and maybe about 5 the year before. You're saying that you should be cash flow positive by 25-26.
In FY26, absolutely. And there'll be a tipping point during the course of FY25 as we go from burning cash to actually generating cash. So in that year will be effectively a neutral year for us, but it will be a year that we will stop burning cash. And I think a good way to look at it is in terms of going forward, if we grow that revenue base and hold the operating costs, we've guided to around 9% free cash flow margin by FY26. So that's one way to look at it in terms of our revenue and our cash flow.
I seem to recall writing in June or thereabouts that at that stage I think your cash burn was a little higher than you're saying it is now. You had about 15 months to run, so there was clearly going to be a capital or debt need at some stage. However, that was when we were speaking. That was when Valaris, an offshoot of Constellation Software, Toronto Stock Exchange listed inveterate investor in companies like yours, clearly believed enough about the story and liked the look of the share price at 77 cents to start piling in and bought nearly 18% of the company at that point and launched a takeover bid, which the board rejected. That's a huge vote of confidence at one level, although the vote of confidence is always partially price dependent. Can you talk to us at all about how you think about or thought about that offer when it came?
Back in June, so they made what was called a non-binding indicative offer. So they approached the EROAD board and offered for $1.30 the chance to do some due diligence with EROAD. The board then turned their mind to what they see to be the long-term value of the company and compared it to the offer that was made. And off the work that they did with the advisors, they looked at it and said, look, we believe it materially undervalues what we believe is the long-term prospect of the company. And that's particularly so off the back of what we just talked about in terms of where we see a revenue generating and growth by FY26, where we see a cash flow is going to be. And the board's very much confident with their strategy and their ability to deliver on that. And off the back of it, they advised Valaris that they weren't going to advance that non-binding indicative offer given the basis that materially undervalued the company in the long term. We haven't engaged formally with Valaris subsequent to that. And from our perspective, and the board's perspective is it's all about delivering on our strategy and giving the confidence to shareholders that we can stem the cash flow burn, we can get us to being in a positive situation and continue the growth story that we can see in North America. And there's real value to that, which we're excited to deliver on for our shareholders.
And of course, the one step I suppose I've left out is that as well as dealing with a bit of a turnaround strategy in the background, you had also sent Goldman Sachs out into the world to look for strategic partners. Can you just clarify whether that process remains in place? As Goldman, are you still looking for potential strategic partners?
Yeah, and I'll give a bit of context to that, Patrick. So back when we did our announcement around our revised strategy in March of this year to investors, we were confident around the numbers we gave to the market around the growth profile that we had and the ability to stem cash burn. We also said, look, if there's an opportunity for us to partner in North America, we're really open to doing so too. And the reason for that is we actually have some really good partnerships already in New Zealand around how we go to market and how we sell a solution. And it makes sense to look at those similar sorts of partnerships we can do in North America. So what we said to the market was there's sort of three areas we're looking at. First is, are there potential opportunities in the US to go to market where we can collaborate with others and provide us with a new customer base that we're not targeting already? It's a very large country, so there's different ways we can go to market. We're really open to doing so. Second, there's around the technology partnerships. Now, we do partner with others around providing more value to customers around our hardware and our SaaS solution. So the opportunity is there. We're really open to that too. And finally, if they're willing to come with funding, then we'll be open to those conversations as well. Those conversations are still ongoing. We know we're still having conversations on that front around potential opportunities around go-to-market and technology partnerships. And we're hopeful that they'll come to fruition in the foreseeable future. So they are ongoing, but they're not needed for us to actually deliver on our strategy in terms of our growth and our cost of turning around the core. They're nice to have, but they're not needed. And so we're excited to continue to explore those in the market.
Great. Thanks very much for your time today.
Thank you, Patrick. I appreciate the time.
We also have a special offer for Sharesies investors from BusinessDesk. If you use the promo code SHAREDLUNCH2023, all one word, you'll get $100 off an annual subscription to BusinessDesk, usually $349 including GST. And from next week, you'll get the Wall Street Journal for free with it as well. The offer only applies to new BusinessDesk subscribers, can only be used once per subscriber, and can't be used with any other discounts. Enjoy the rest of your week.